Welcome back to CMA USA Exam Coach, your trusted companion for CMA exam preparation. In this episode, we're diving into a very important topic in corporate finance: bonds. As we mentioned in our earlier video on long-term finance, bonds are external sources of long-term financing, used by corporations to raise large amounts of capital from the public or institutional investors. For your CMA exam, it's essential to understand bonds in great detail. We will explore topics such as how bonds are issued and priced, what happens when bonds are sold at a premium or a discount, the concept of Macaulay duration, various types of bonds like secured, unsecured, convertible, callable, and more, and many other essential bond-related concepts. So stay tuned. This is going to be a detailed session and a vital part of your CMA exam syllabus. Let's get started. Let's begin by understanding what is a bond. A bond is a financial instrument used by corporations or governments to borrow money from investors for a fixed period. In return, the issuer agrees to pay periodic interest, called a coupon, and repay the original amount, known as the principal, at maturity. Now, how does this differ from a bank loan? In a bank loan, a company borrows money directly from a bank and pays interest on it. In contrast, a bond is a form of borrowing from the public or institutional investors, not from a bank. The company issues bonds and individual or institutional investors purchase them, effectively lending money to the company. The company then pays interest, called a coupon, usually semi-annually or annually, to the investors. Let's now understand some of the terms in a bond. The borrower or issuer, usually a corporation or government that needs funds. The lender or investor, individuals or institutions who buy the bond. The coupon rate, the annual interest rate paid to the bondholder, calculated on the face value. The face value, usually $1,000, which is the principal amount repaid at maturity. The maturity period, the duration after which the issuer repays the full face value. In summary, the borrower or issuer promises to pay regular interest based on the face value and coupon rate, and also promises to repay the full principal at the time of maturity. Even though the face value of a bond is typically $1,000, this is not necessarily the price at which the bond is sold. The selling price of a bond depends on prevailing market interest rates. If the market rate is higher than the coupon rate, the bond will be sold at a discount, less than $1,000. If the market rate is lower than the coupon rate, the bond will be sold at a premium, more than $1,000. We will learn more about how to calculate the selling price of a bond in the upcoming slides. Now we will discuss how the selling price of a bond is calculated. The selling price of a bond is basically the present value of all the future cash flows from the bond. This includes the regular interest payments, also called coupon payments, and the principal amount that will be repaid at the end of the bond term. There is a formula to calculate the bond price, which adds up the present value of each coupon payment and the present value of the face value. But for CMA exam purposes, you don't need to memorize or apply this formula. What you really need to understand is the relationship between the coupon rate and the market interest rate. If the market interest rate is higher than the bond's coupon rate, the bond will be sold at a discount. If the market interest rate is lower than the coupon rate, then the bond will be sold at a premium. And if both rates are the same, then the bond will be sold at its face value. So rather than solving using formulas, in CMA, we focus on understanding the logic and identifying whether the bond is issued at face value, premium, or discount. Now, let's understand a practical example. Suppose a company issues a bond with the following details. Face value is $1,000. Coupon rate is 10%. Market interest rate is 8%. And the bond term, or duration, is 5 years. So what do these numbers mean? Let's start with the basics. The face value of $1,000 means that the company promises to repay $1,000 to the investor at the end of 5 years. Next, the coupon rate of 10% means the company will pay 10% interest annually on the face value. That is, the bondholder will receive $100 every year as interest. But here's where it gets interesting. The market interest rate right now is only 8%. That means other new bonds being issued in the market are only offering 8% interest. So, when we compare, our bond is offering a higher interest of 10%, while the market average is just 8%. This makes our bond more attractive to investors. Why? because it gives more return than other bonds in the market. Everyone wants a better return for their money. As a result, this bond becomes more in demand. And whenever something becomes more desirable, its price goes up. That's basic supply and demand. So in this case, although the face value of the bond is $1,000, the company may be able to sell it at a higher price, like $1,050 or even $1,100. This is what we mean when we say the bond is being sold at a premium. Let's recap. The bond is giving a higher interest than the market. That creates more demand from investors. More demand leads to a higher price. So the bond is sold at a premium, that is, for more than the face value. This is a classic example of a bond being sold at a premium because the coupon rate is higher than the market interest rate. Let's now look at another scenario, this time the opposite case. Assume a company issues a bond with these details. Face value is $1,000. Coupon rate is 8%. Market interest rate is 10%. And the bond term is 5 years. So what's going on here? Again, the face value of $1,000 means the bondholder will receive that amount at the end of the bond's term, after 5 years. Now, the coupon rate is 8%. That means the investor will receive 8% of the face value every year, which is $80 annually as interest. However, the market interest rate is 10%. This means that other bonds in the market, new ones being issued, are offering 10% interest. Let's compare. Our bond pays 8%. But new bonds in the market are paying 10%. So, what do you think an investor will prefer? Of course, a bond that gives higher interest. No one would want to invest in something that gives less return unless there's a good reason. As a result, our bond becomes less attractive. Investors can get more return elsewhere. And to make up for the lower interest, the company has to lower the price of the bond to make it appealing. So, instead of selling the bond at its face value of $1,000, the company might sell it for $950, or even lower depending on the situation. This is what we mean when we say the bond is being sold at a discount. Let's break it down again. The bond offers a lower return than the current market rate. So investor demand is weaker. To attract buyers, the bond must be offered at a lower price. And that's why it sells for less than the face value, or at a discount. So anytime the coupon rate is lower than the market interest rate, the bond is sold at a discount. This discount balances the lower interest payments, so the buyer still gets a competitive return overall. Now let's look at a situation where the coupon rate and the market interest rate are exactly the same. Here are the details of the bond. The face value is $1,000. The coupon rate is 10%. The market interest rate is also 10%. And the bond has a 5-year duration. Let's unpack what this means. The face value tells us what the investor will get back at the end of 5 years, $1,000. The coupon rate of 10% means the investor will earn 10% of the face value each year. That is $100 annually as interest. Now compare this to the market rate, which is also 10%. So this bond is paying the same return as other bonds in the market. As an investor, if you're looking around and see this bond offering 10% and other new bonds also offering 10%, then this bond is considered equally attractive. There's no advantage, but also no disadvantage. This creates a balance between investor expectations and what the company is offering. As a result, the bond will be sold at its face value, which we call par value. So, when the coupon rate equals the market interest rate, the bond is sold at par. No discount, no premium, just the exact amount of $1,000. In this case, the company doesn't need to adjust the price of the bond. Investors are satisfied because they are getting a market-competitive return, and the company raises the funds it needs without offering additional benefits. Let's quickly summarize. Coupon rate is 10%. Market interest rate is also 10%. So, the bond offers the same return as other bonds in the market. Therefore, investor demand is stable. And the bond sells at par value, which is $1,000. This is the most neutral scenario in bond pricing. In the next section, we'll learn how to calculate the actual selling price of a bond using present value techniques, so you'll understand the math behind these concepts. Before we dive into the actual bond price calculation using present value techniques, let's clarify one very important concept. No matter how the bond is priced, whether it's sold at a discount, at par, or at a premium, the return to the investor, also called the yield, will ultimately be the same. Yes, you heard that right. Whether an investor buys the bond for $900, $1,000, or even $1,100, their actual return, the effective yield based on the market, will be aligned with the market interest rate. Let's break this down a little more. If the bond is purchased at a discount, the investor gets less interest annually, but they also pay less for the bond. So the extra profit comes when the bond matures and they receive the full face value, which increases their return. If the bond is purchased at par, it's straightforward. The interest and final repayment match the price paid, so the return is exactly the coupon rate, which also equals the market rate. And if the bond is purchased at a premium, the investor gets higher annual interest, but they've paid more upfront, so that reduces the final gain when the bond matures. Again, this balances out the return to match the market rate. This is a key concept in bond pricing, and we'll see it clearly when we do the present value calculations in the next slides. By calculating the present value of the coupon payments and the present value of the principal, we will determine the actual selling price of the bond. Then, we'll see how each scenario, premium, discount, and par, provides the same yield in the eyes of the investor. So keep this point in mind. The pricing may change, but the investor's return adjusts accordingly. Let's now begin calculating the bond price using the present value method and understand how all the pieces fit together. Now, we are going to calculate the selling price of a bond, specifically a bond that is being sold at a premium. Let's start by understanding the same previous scenario. The face value of the bond is $1,000. The coupon rate is 10%. The market interest rate is 8%. And the duration of the bond is 5 years. Now, what does this tell us? A coupon rate of 10% means the bond will pay 10% of its face value every year as interest. Since the face value is $1,000, this gives us an annual interest payment of $100. So over 5 years, the bond will pay $100 per year, totaling $500 in interest. However, this is not the selling price of the bond. We still need to calculate that. To find the selling price, we need to determine the present value of all the future cash inflows the bondholder will receive. There are two components, the annual interest payments and the final face value repayment at the end of the bond's term. Let's start with the interest. The bondholder receives $100 every year for 5 years. Because this is a fixed and equal annual inflow, we treat this as an annuity. To find the present value of an annuity, we use the present value annuity factor from the annuity table. So, let's open the annuity table and look under the column for 8% interest rate and row for 5 years. The factor we find is 3.993. Now we multiply this factor by the annual interest. $100 multiplied by 3.993 equals $399.30. This is the present value of the total interest inflows over 5 years. Now let's move to the second part, the principal repayment. At the end of 5 years, the bondholder will receive the $1,000 face value. Since this is a single lump sum received in the future, we use the present value table, not the annuity table. In the present value table, under 8% and 5 years, the factor is 0.681. Now we multiply this factor by $1,000. 1,000 times 0.681 equals $681. So the present value of the principal repayment is $681. Now we add both present values together to find the selling price. The present value of the interest is $399.30. The present value of the principal is $681. When we add them together, we get $1,080.30. This is the selling price of the bond. Now let's interpret what this means. The bond is offering a 10% coupon rate, while the market is offering only 8%. This bond is giving more return than the current market rate. Because of this, the bond becomes more attractive to investors. And when demand increases, the price goes up. That's why this bond is being sold at a premium. Although the face value is $1,000, the bond is actually being sold for $1,080.30. This is a perfect example of how we calculate the selling price of a bond using present value techniques. Now let's look at a bond that is selling at a discount. We are using the same example structure as before. The face value of the bond is $1,000. The coupon rate is 8%, while the market interest rate is now 10%, and the duration of the bond is 5 years. This time, our bond is offering a lower interest rate compared to the market. Since the bond gives only 8%, while the market offers 10%, the bond becomes less attractive to investors. So, to encourage investors to buy this bond, the company will have to offer it at a price lower than the face value. And that's what we call selling at a discount. Let's go through the cash flows. Every year, the investor will receive $80, which is calculated by multiplying the face value of $1,000 by the coupon rate of 8%. Over 5 years, that gives us a total of $400 in interest. But as we've learned before, when calculating the present value, we need to discount these future interest payments using the market rate, which is 10% in this case. Since the annual payments are equal, we will use the present value annuity factor for 5 years at 10%. From the present value table, this factor is 3.791. So we multiply $80 by 3.791, which gives us the present value of the interest payments, $303.28. Now, we also receive the face value of $1,000 at the end of 5 years. This is a one-time cash inflow, so we'll use the present value of a lump sum factor for 5 years at 10%, which is 0.621. Multiplying 1,000 by 0.621 gives us $621, the present value of the principal repayment. Now let's add both the present value of the interest and the present value of the principal. 303.28 plus 621 equals $924.28. So the selling price of the bond in this case is $924, which is less than the face value of $1,000. That confirms our expectation. The bond is selling at a discount. Again, just like we explained earlier, even though the bond is sold at a discount, the investor is effectively earning the market rate of 10% because the selling price was adjusted to make up for the lower coupon rate. This method helps ensure that all bonds, whether sold at a premium, at par, or at a discount, offer the correct return based on current market conditions. Now let's look at the final scenario, when a bond is sold at par value. In this case, the face value of the bond is $1,000, the coupon rate is 10%, and the market interest rate is also 10% with a duration of 5 years. This is a perfect balance. The interest offered by the bond is exactly equal to what the market expects. So, there's no premium and no discount. The bond will sell exactly at its face value of $1,000. Let's calculate the cash flows and confirm this using present value techniques. Every year, the bondholder will receive $100 in interest. That's simply 10% of the $1,000 face value. Over 5 years, this totals $500 in interest income. Because the interest payments are equal every year, we will use the present value annuity factor to find out the present value of these inflows. We go to the present value annuity table and look under 10% for 5 years. The factor is 3.791. Now, multiply the $100 annual interest by the annuity factor, 3.791, and we get $379.10. This is the present value of all the interest payments. Next, we need to calculate the present value of the principal, which is $1,000 received at the end of 5 years. Since this is a one-time payment, we use the present value of a single sum. From the present value table, the factor for 10% over 5 years is 0.621. Multiply 1,000 by 0.621, and you get $621. This is the present value of the bond's principal repayment. Now, we add the present value of the interest and the principal. 379.10 plus 621 equals $1,000.10, essentially $1,000. This confirms that the selling price of the bond is equal to its face value, and this is known as selling at par. Why does this happen? Because the bond's interest payments are aligned with the market rate. Investors are receiving the exact return they expect, so there's no need to adjust the price. That's why the bond sells at face value, not higher, not lower. Just like in the previous examples, the key takeaway is that the market adjusts the bond's price to ensure that the effective yield matches the current market interest rate. So in this case, the bondholder receives exactly what the market demands, no premium and no discount, and the bond is sold at par. Now we understand how to calculate the selling price of a bond in each situation, whether it's sold at a premium, at a discount, or at par. Each scenario depends on the relationship between the coupon rate and the market interest rate. And we've seen how to apply present value techniques using both the annuity and single sum tables. Now let's take the same premium bond example, but with a semi-annual interest payment structure. This is a common setup for many bonds, so it's important to understand how the calculation changes. We are given a face value of $1,000. The coupon rate is 10% annually, but since payments are made semi-annually, we divide that by 2. So, each period's interest will be 5% of $1,000, which gives us $50 every 6 months. Now, the bond has a 5-year duration, and because it pays interest semi-annually, that means there are 10 periods in total. Next, to find the present value of this series of interest payments, we use the present value of annuity factor. At a market rate of 8% annually, or 4% per period semi-annually, the annuity factor for 10 periods at 4% is 8.111. Now multiply this factor with our periodic interest of $50. 50 multiplied by 8.111 equals $405.55. This is the present value of the interest payments over 10 periods. Now, moving on to the principal repayment. At the end of the 10th period, which is the end of the year 5, the bondholder will receive the face value of $1,000. To find the present value of this lump sum amount, we use the present value factor. Again, using the 4% rate for 10 periods, the PV factor is 0.676. Multiply 1,000 by 0.676, and we get $676. This is the present value of the face value amount we will receive at maturity. Now, let's add both present values together. 405.55 plus 676 equals $1,081.55. So, the selling price of the bond is $1,081.55, which confirms again that this bond is sold at a premium because it offers a coupon rate higher than the market rate. Now here's something important to remember. The numbers shown in the present value and annuity tables do not always represent years. They actually represent periods. These periods can be defined as weeks, months, quarters, semi-annual intervals, or years, depending on how frequently the interest is paid. So in this case, even though the bond duration is 5 years, we are looking at 10 periods because of semi-annual payments. This is a very common area of confusion, so keep that in mind when you're using present value tables during the exam. Even though one bond pays annually and the other semi-annually, the selling price remains the same, approximately $1,080, which is above face value. That means in both cases, the bond is sold at a premium. Now that you understand how to handle semi-annual bonds, you're one step closer to mastering bond pricing techniques. Let's now talk about yield to maturity, often abbreviated as YTM. This is one of the most important concepts when analyzing bonds. So, what is yield to maturity? Yield to maturity is the rate of return an investor can expect to earn if they buy a bond today and hold it until maturity, receiving all the scheduled interest payments and the principal at the end. In simple terms, YTM answers this question. If I buy this bond now and keep it until it matures, what will be my average annual return, considering both interest income and any gain or loss from buying the bond at a discount or premium? It's like the bond's internal rate of return, the interest rate that equates the present value of all future cash flows from the bond to the price you paid for it. YTM includes periodic coupon payments you'll receive, principal repayment at maturity, the current purchase price of the bond, the time to maturity of the bond. Now here's the interesting part. If a bond is purchased at par, the YTM is exactly equal to the coupon rate. If it's purchased at a discount, the YTM is higher than the coupon rate because the investor gains from buying the bond at a lower price. And if the bond is purchased at a premium, the YTM will be lower than the coupon rate, since part of the initial investment is lost when the bond is redeemed at face value. Why is YTM important? Because it allows investors to compare bonds with different coupon rates and different prices on an equal footing. Instead of just looking at the interest rate, YTM shows the true return adjusted for current price, maturity, and total cash flow. One more point. YTM assumes that the investor holds the bond until maturity and all coupon payments are reinvested at the same YTM rate. In real life, these conditions may not always be met, but YTM still gives a very useful estimate for bond comparison and decision-making. Now let's understand how to calculate yield to maturity, or YTM, using a simple example. And for that, we'll take the same scenario we used earlier, the case where the bond is sold at a premium. So here are the details. the face value of the bond is $1,000. The coupon rate is 10%. The market interest rate is 8%. And the duration of the bond is 5 years. Now, because our bond is offering a higher coupon rate than the market rate, it will naturally attract more buyers. This increased demand causes the bond's price to rise above its face value, meaning the bond will be sold at a premium. Let's walk through the steps quickly, just like we did in our earlier calculation. Step 1. We calculate the annual interest that the bond pays. Take the face value, $1,000, and multiply by the 10% coupon rate. That gives us $100 per year. Over 5 years, we will receive $100 multiplied by 5 equals $500 in total coupon payments. Now we discount this $500 to its present value using the present value of an annuity factor. Since the bond pays interest every year in equal amounts, we use the annuity table. At a market rate of 8% for 5 years, the annuity factor is 3.993. Now, multiply $100 per year, multiply by 3.993 equals 399.30. So, the present value of the total interest payments is $399.30. Step 2. Now let's discount the face value of $1,000, which we will receive at the end of the 5th year. We'll use the present value of one table. At 8% for 5 years, the factor is 0.681. So, 1,000 times 0.681 equals $681. That's the present value of the principal repayment. Now, add both present values together. 399.30 plus 681 equals $1,080.30. This is the selling price of the bond. Since this is higher than the face value, we confirm again, the bond is being sold at a premium. Now, let's move on to calculating the yield to maturity, or YTM. The yield to maturity is the average annual return the investor will earn if they buy the bond at its current price and hold it until maturity. So let's look at the total return from the bond. First, they will receive $500 in interest over 5 years. Second, they will receive $1,000 at maturity. So in total, they are receiving $1,500. Now, compare that to what they paid, the current selling price of $1,080. So, total return equal 1,500 minus 1,080. We will get $420. Now, let's calculate the total yield. 420 divided by 1,080 equals approximately 38.89% over 5 years. To get the annual yield, we divide that by 5. 38.89 divided by 5 equals approximately 7.78% per year. So, what does this mean? Even though the bond offers a 10% coupon, since we purchased it at a premium price, our actual annual return, or yield to maturity, is around 7.78%. This confirms a very important principle. When a bond is purchased at a premium, the YTM will be less than the coupon rate. And in this case, it closely matches the market interest rate of 8%, which is expected. In fact, whether a bond is purchased at a discount, premium, or par, the YTM will always tend to align closely with the prevailing market interest rate, assuming the bond is held to maturity. This is why yield to maturity is such a useful metric. It gives a true picture of the return, factoring in coupon, price, and time. Now, here's an important exam tip you should keep in mind. Sometimes, in your CMA exam, you might get a question asking, what is the yield to maturity of a bond? And in the options, they may also provide the market interest rate. In such cases, you can confidently pick the market rate as the answer, even without doing a single calculation. Why? Because yield to maturity, or YTM, is designed to reflect the true return the investor earns on the bond, and this return always aligns with the market rate of interest at the time the bond is sold. So whether the bond is sold at a discount, at par, or at a premium, the yield to maturity will always adjust in such a way that the final return matches the market rate, assuming the bond is held till maturity. So just remember, if the market rate is given in a YTM question and no complex calculation is asked, you can safely choose the market rate as the YTM. That's one easy mark saved in your exam. We'll understand some special features of bonds, important concepts you need to know for both exam and real-world finance. Let's begin with the term bond indenture. The bond indenture is the legal contract or formal agreement between the bond issuer, usually a corporation or government, and the bondholders, the investors. It spells out all the critical terms of the bond, including the principal amount or face value, the interest rate or coupon rate, the payment schedule, maturity date, and other obligations of the issuer. In short, this document is like the rulebook of the bond. It protects the interests of the bondholders and ensures that the issuer sticks to the promises made at the time of issue. Let's explore the special features of bonds, beginning with restrictive covenants, followed by special provisions. These features are critical because they define the rights and limitations for both bondholders and issuers, and can significantly affect the risk, return, and structure of the bond. First, let's start with restrictive covenants. These are legally binding clauses included in the bond indenture, the contract between the bond issuer and bondholders. The purpose of restrictive covenants is to protect the bondholders by limiting risky behavior by the issuer. Let's go through the key types. 1. Financial ratios to be maintained. The bond agreement may require the issuer to maintain certain financial health indicators. For example, a minimum current ratio to ensure short-term liquidity, or a maximum debt-to-equity ratio to prevent the company from becoming over-leveraged. These ratios help ensure that the company remains capable of repaying its bond obligations. 2. Sinking fund requirement. This clause requires the issuer to set aside a fixed amount of money each year into a fund. This fund will be used to repay the bond principal when it matures. It lowers the risk of default at maturity because the repayment amount is accumulated gradually rather than in one large payment. 3. Pledging of collateral. The issuer may be required to pledge specific assets as collateral against the bond. For example, a real estate company might pledge a property, or a manufacturer might pledge equipment or inventory. This increases the bond's security because if the issuer defaults, the bondholders have a legal claim on those assets. 4. Negative pledge clause. This clause prevents the issuer from pledging the same assets to other lenders in the future. It ensures that the bondholders' collateral remains exclusive and they don't lose their security if the company issues new debt later. Now let's move to the special provisions of bonds. These are additional features that give flexibility to either the issuer or the investor and often make the bond more attractive or manageable. 1. Call provision. A call provision gives the issuer the right to repay the bond early before its maturity date. This typically happens when interest rates fall. For example, if the company issued a bond at 10% and the market rate drops to 6%, the company can call the bond, repay it early, and then issue a new bond at a lower rate, saving on interest costs. This is favorable to the issuer, but not to the investor, which is why callable bonds often offer higher interest rates to compensate for this risk. 2. Put provision. This gives the bondholder the right to sell the bond back to the issuer before maturity. This protects the investor in case interest rates rise or the issuer's creditworthiness declines. It allows them to exit the investment early and reinvest elsewhere. This is favorable to the investor and often results in the bond offering lower interest rates than regular bonds. 3. Convertibility clause. This provision gives bondholders the option to convert their bonds into equity shares of the issuing company. This means they can switch from being a lender to a part owner. It's beneficial when the company's stock performs well, giving the bondholder an opportunity to benefit from share price appreciation. Convertible bonds usually offer lower coupon rates, but they provide equity upside potential, making them attractive for long-term investors. In summary, the special features of bonds, including restrictive covenants and special provisions, play a vital role in determining the risk, reward, and flexibility of the bond for both parties. Understanding these features helps investors make smarter decisions and helps issuers structure bonds in a way that aligns with their financial goals. These concepts are highly testable in the CMA exam, so make sure you're confident in each one. Next, we're exploring different types of bonds that you might encounter in finance or investing. Whether you're a student, a finance enthusiast, or someone looking to grow your money smartly, this is for you. So let's get right into it. Let's start with convertible bonds. These are a hybrid between debt and equity. Convertible bonds give the holder the option to convert the bond into a set number of shares of the issuing company. Why does that matter? Well, if the company does well and the stock price rises, converting the bond into shares could be more profitable than just collecting interest payments. It's a way for investors to have the safety of a bond with the upside potential of stocks. Now, let's talk about debentures. These are unsecured bonds, which means they aren't backed by any specific assets. Instead, they rely solely on the creditworthiness of the issuer. Government debentures are typically seen as low risk, but when companies issue debentures, especially if they don't have strong credit ratings, it can be a riskier investment. That higher risk usually comes with a higher return. Mortgage bonds are the opposite of debentures. They're secured by real tangible assets, like buildings or land. That means if the issuer defaults, bondholders have a claim on the underlying property. It's like a safety net for investors, which can make mortgage bonds a more secure option in some cases. Subordinated bonds, also called junior bonds, are another class of riskier debt. These are lower in priority if a company goes bankrupt. That means senior bondholders get paid first, and subordinated bondholders only get what's left, if anything. Because of this added risk, subordinated bonds usually offer higher interest rates to attract buyers. Income bonds are a bit unusual. They only pay interest if the issuing company earns enough profit. There's no guaranteed interest payment, which makes these bonds more speculative. They're often issued by companies in distress or restructuring, and they allow flexibility on when interest is paid, if at all. Serial bonds are issued with staggered maturity dates. Instead of repaying the entire principal at once, the issuer repays portions of it over time. This structure is commonly used by municipalities or large infrastructure projects that want to manage cash flow over multiple years. Now, let's look at zero-coupon bonds. As the name suggests, they pay no periodic interest. Instead, they're sold at a deep discount and you receive the full face value at maturity. For example, you might buy a bond for $700 today, and in 10 years, it matures at $1,000. The return is the difference between what you paid and what you get back. Participating bonds offer more than just fixed interest. They let investors share in the profits of the issuer. That means if the company performs well, you could receive an additional return on top of your regular interest payments. It's like having a bond with a performance bonus built in. Index bonds are linked to a specific economic index, like inflation or the consumer price index. Their payments adjust according to movements in that index. So, if inflation rises, your bond's returns rise with it. These are especially useful when you want to protect your investment's real value over time. And finally, we have international bonds. These come in two main forms: foreign bonds and euro bonds. A foreign bond is issued in a country by a foreign entity, using the country's local currency. For example, a Japanese company might issue bonds in the United States denominated in US dollars. These are known as Yankee bonds. On the other hand, euro bonds are issued in a currency that's different from the country where the bond is sold. For instance, a US company could issue bonds in Japan that are denominated in euros. These bonds offer more flexibility and global reach for both issuers and investors. And that wraps up our look at the major types of bonds you should know about. Each one has its own purpose, risk level, and return profile. Whether you're building a portfolio or just learning the ropes, understanding these differences can help you make smarter financial decisions. Now, let's talk about an important topic that every bond investor should understand: bond ratings and rating agencies. When a company or government issues a bond, they are essentially borrowing money from investors. But before you, as an investor, lend your money, you'll naturally want to know, how risky is this bond? That's where rating agencies come in. What are rating agencies? Bond rating agencies are independent organizations that analyze the financial strength of the bond issuer. They look at how likely the issuer is to pay the interest on time and repay the principal amount when the bond matures. In simple terms, they assess the creditworthiness of the issuer, just like banks assess your credit score before giving you a personal loan. The major credit rating agencies in the United States are Moody's Investor Service, Standard & Poor's, S&P Global Ratings, Fitch Ratings. These three agencies dominate the global credit rating industry and are widely trusted by investors, regulators, and institutions. How do bond ratings work? Rating agencies assign letter grades to bonds to indicate their level of risk. These ratings range from the highest quality, meaning very low risk of default, to the lowest quality, which indicates a high risk of default. Let's break down the rating scales. Standard & Poor's and Fitch rating scale. AAA, the highest rating. Extremely safe. Issuer has a strong ability to meet financial commitments. AA, very high quality, low credit risk. A, strong, but slightly more affected by economic changes. BBB, still investment grade, but the lowest tier of safety. Moody's rating scale, note the different symbols. AAA, equivalent to AAA. AA, equivalent to AA. Same. BAA, equivalent to BBB. All of these above ratings are considered investment-grade bonds, meaning they are suitable for most investors, including institutions like pension funds. What are junk bonds? Bonds rated below investment grade are called high-yield bonds, or more commonly, junk bonds. These include BBBA, BB, CCC, CAA, CCCA, C, extremely risky, D, defaulted. These bonds offer higher interest rates, also called yields, to compensate for the higher risk. That's why they're called high yield. But they carry a much greater chance of loss. Why bond ratings matter? Investors use ratings to quickly assess the risk of a bond before investing. Companies with higher credit ratings can raise funds at a lower interest cost. Lower-rated companies have to offer higher interest payments to attract investors. Can bond ratings change? Yes! Bond ratings are not fixed forever. Rating agencies regularly review the issuer's financial performance and economic environment. If a company's situation improves, their rating may be upgraded. If it worsens, their rating can be downgraded, which may cause the bond price to fall. For example, during economic downturns, even large companies can face rating downgrades, increasing their cost of borrowing. So to summarize, bond rating agencies like Moody's, Standard & Poor's, and Fitch help investors by assigning risk grades to bonds. AAA or AAA means top-level safety. BBB or BAA and above means investment grade. Below that are junk bonds, offering high return but with high risk. These ratings guide investors in making informed decisions and help the bond market run smoothly. Let's move on to an important concept in debt financing, that is the cost of debt. Simply put, the cost of debt is the effective rate a company pays on its borrowed funds. This includes loans, bonds, or any other form of debt. It tells you how expensive borrowing is for a company and plays a big role in calculating the weighted average cost of capital, or WACC. Now, here's the basic equation for cost of debt. Cost of debt equals total interest expense divided by total debt times 100. This gives you the nominal rate, the percentage of interest the company is paying before tax. Let's see how this works with a simple example. Imagine a company has issued $1 million in bonds and pays $80,000 in interest annually. Using the formula, cost of debt equal $80,000 divided by 1 million multiplied by 100 gives 8%. So the company's cost of debt is 8%. That's the return lenders expect for taking on the risk of lending money to the company. But here's where it gets interesting. Interest on debt is tax deductible. This means the after-tax cost of debt, or the effective interest rate, is actually lower than the nominal rate. Why? Because the company saves money by paying less in taxes. Here's the formula for that. After-tax cost of debt equals cost of debt times 1 minus tax rate. Let's apply that to our earlier example. Suppose the corporate tax rate is 30%. After-tax cost of debt equals 8% times 1 minus 0.30 gives 5.6%. That 5.6% is what the debt actually costs the company after accounting for the tax shield. So, to wrap it up, the cost of debt tells you how much borrowing really costs a company. But when calculating the true cost, always factor in the tax rate, because that tax benefit can make a big difference in financial planning and investment decisions. Let's now calculate the cost of debt using a more detailed formula that includes issuance costs. Here's the formula. Cost of debt equals face value multiplied by coupon rate divided by issue, price minus issuance, cost multiplied by 1 minus tax rate. This gives us a more accurate view of what the debt truly costs the company after factoring in the cost of raising that debt and the tax shield. Here are a few sample problems to walk through. A company issues bonds with a face value of $1 million at a 10% annual coupon rate. The bonds are sold at $950,000, and the issuance costs are $30,000. The corporate tax rate is 25%. Using the formula, we calculate cost of debt equals 1 million. Multiply by 0.10 divided by 950,000 minus 30,000, multiply by 1 minus 0.25. That's $100,000 divided by $920,000 times 0.75. The result? A cost of debt of approximately 8.15% after taxes. Let's break down example 1 to understand what the numbers actually mean. The company is paying 10% interest on a face value of $1 million. So that's $100,000 in annual interest payments. However, they didn't actually receive the full $1 million. They raised only $950,000, and after deducting issuance costs of $30,000, the net proceeds were $920,000. So effectively, they're paying $100,000 interest on $920,000 of usable funds, which gives a pre-tax cost of debt of about 10.87%. But here's the key. Interest payments are tax deductible. At a tax rate of 25%, the company saves $25,000 in taxes from that $100,000 interest expense. When we apply that tax shield, the after-tax cost of debt drops to 8.15%. So in simple terms, while the debt carries a nominal cost of 10%, thanks to the tax benefit, the true cost to the company is only 8.15%. This is the effective interest rate the company really pays for using debt capital. The company pays 10% interest on its bonds, but after adjusting for the issuance cost and the tax benefit, the true after-tax cost of debt comes out to 8.15%. This tax adjustment is critical because interest expense reduces taxable income, and that tax saving lowers the actual cost of borrowing. And here's something you must remember, especially if you're studying for the CMA exam. This tax adjustment applies only to debt because only interest on debt is tax deductible. You do not apply the tax rate when calculating the cost of preferred or common equity. So don't make that mistake on the exam or in real-world analysis. This is a high-probability test question and a core concept in corporate finance. Next, we'll explore the important relationship between interest rates and the yield curve, a concept that is widely used in both investment decisions and economic forecasting. Let's begin by understanding what a yield curve is. A yield curve is a graphical representation that shows the relationship between the interest rates or yields of bonds with the same credit quality, typically government bonds, but different maturities, such as short-term, medium-term, and long-term. The curve helps us understand how investors expect interest rates to behave in the future. Based on the shape of the yield curve, we can make important conclusions about market expectations, investor sentiment, and even potential economic conditions. To begin with, imagine a simple graph. On the x-axis, we have time to maturity. This could be 1 year, 2 years, 5 years, 10 years, or 30 years. On the y-axis, we have interest rates or yields. When we plot the interest rates of bonds with the same credit quality, like government bonds, but with different maturities, we get a line. This line is known as the yield curve. Now, based on economic conditions, investor expectations, and monetary policy, this curve can take different shapes. Each shape gives us a clue about where the economy might be headed. There are 4 common types of yield curves, each with its own meaning. 1. Normal yield curve, also known as an upsloping yield curve. This is the most common shape. It occurs when longer-term bonds have higher yields than shorter-term bonds. The curve rises from left to right. What does it indicate? It reflects positive investor expectations. The market believes that the economy will grow in the future and interest rates may rise. Investors expect to be compensated more for locking their money in longer-term securities due to inflation and risk. Investors prefer short-term investments in this situation. Why? Because long-term investments carry more uncertainty and inflation risk, so investors demand a higher return to compensate for the risk. That's why long-term rates go up, to attract fewer willing long-term investors. So when the curve is upward sloping, we assume that more investors are in the short term and fewer are in the long term, which causes long-term rates to rise. 2. Humped yield curve, also called bell-shaped or curved. This is a less common curve, where medium-term yields are higher than both short-term and long-term yields, creating a hump in the middle. What does it indicate? It often signals market uncertainty. Investors might expect interest rates to rise in the short term, then fall again in the long term, possibly due to expected economic slowdown or intervention by the central bank. This suggests investors are uncertain about the short term and the long term, possibly expecting near-term growth followed by a slowdown. So, money flows into medium-term bonds, driving up those rates. This often signals a transitional phase in the economy. 3. Flat yield curve. In a flat yield curve, short-term and long-term interest rates are nearly the same. The curve appears almost horizontal. What does it indicate? A flat curve typically appears during transitions in the economy, especially when the market is uncertain about future growth. It may suggest that investors expect interest rates and economic conditions to remain stable in the near term, or it may signal an upcoming economic slowdown. This usually shows that investors are equally split between short-term and long-term. It reflects uncertainty. Investors aren't confident in committing long-term, and even short-term rates aren't giving them enough return. It often appears just before a major economic shift, like a recession or recovery. 4. Inverted yield curve, also known as a downward sloping curve. This happens when short-term interest rates are higher than long-term rates, so the curve slopes downward from left to right. What does it indicate? This is considered a strong warning sign. An inverted yield curve is often seen as a predictor of a recession. It shows that investors expect economic conditions to worsen and interest rates to drop in the future, possibly due to declining demand and lower inflation. In this case, investors are moving toward long-term bonds, even though the returns are lower. Why? Because they expect the economy to weaken and interest rates to fall. So they want to lock in a fixed return before that happens. Heavy investment in long-term bonds pushes their yields down. This is usually a strong signal of an upcoming recession. In summary, the yield curve is a powerful tool used to understand interest rate expectations and market confidence. A normal curve signals healthy economic growth. A flat or humped curve reflects uncertainty. And an inverted curve is usually a warning of a future downturn. Let's explore a foundational concept in fixed income, the yield curve, and the 4 major theories that explain its shape. The yield curve is a graph that shows the relationship between bond yields, interest rates, and their time to maturity. Normally, longer-term bonds have higher yields than short-term ones, but that's not always the case. So, why does the yield curve slope the way it does? There are 4 key theories that try to explain it. Pure expectations theory, liquidity premium theory, segmented market theory, preferred habitual theory. Let's break them down one by one. 1. Pure expectations theory. The pure expectations theory says that the shape of the yield curve reflects investor expectations about future interest rates. Here's the idea. If the curve is upward sloping, it means investors expect interest rates to rise in the future. If it's downward sloping, they expect rates to fall. According to this theory, long-term rates are simply an average of expected short-term rates. There's no premium for holding long-term bonds. You earn more only because investors expect rates to rise. For example, if a 1-year bond yields 4% and a 2-year bond yields 5%, that implies that the market expects the second year's 1-year rate to be about 6%. But this theory has a flaw. It assumes investors are completely indifferent between short-term and long-term bonds. And that's not realistic. 2. Liquidity premium theory. The liquidity premium theory builds on the pure expectations theory, but adds a more realistic element. Investors demand a premium for locking their money away longer. Long-term bonds are riskier. They're more sensitive to interest rate changes and inflation. So, investors want extra compensation, called a liquidity premium, for holding them. The formula now becomes long-term rate = average of expected short-term rates plus liquidity premium. This explains why the yield curve is usually upward sloping, even if investors don't expect interest rates to rise much. So, even if future short-term rates are expected to stay the same, longer bonds still yield more because of this built-in premium for risk and reduced liquidity. 3. Segmented market theory. Now, let's switch to a very different view, the segmented market theory. This theory says, the bond market is made up of separate, independent segments, each with its own supply and demand. In other words, short-term and long-term bonds are not substitutes. Some investors, like banks, prefer short-term bonds. Pension funds or insurance companies prefer long-term ones. So, interest rates in each segment are determined by the forces of supply and demand within that segment, not by expectations about future rates. For example, if there's high demand for long-term bonds from retirement funds, long-term yields may fall, even if future short-term rates are expected to rise. This theory explains why the yield curve can have any shape depending on investor behavior in different segments. 4. Preferred habitual theory. Finally, we have the preferred habitual theory, a hybrid of the previous two. This theory agrees with segmented markets in one way. Investors have preferred maturities or habitual. But unlike segmented market theory, it says investors can be convinced to leave their preferred maturity if they're offered a higher return. So, if a pension fund prefers 10-year bonds but sees a great opportunity in 2-year bonds, it might still invest if the risk-return trade-off is worth it. The idea here is that investors require a premium to move out of their comfort zone, and that shapes the yield curve. Summary: what do these theories tell us? Pure expectations. Theory yield curve reflects only future interest rate expectations. Liquidity premium theory adds a risk premium for long-term bonds. Segmented market theory. Interest rates are determined by supply and demand in independent maturity segments. Preferred habitat. Theory. Investors prefer certain maturities, but will shift for higher returns if compensated. Understanding these theories helps investors, analysts, and financial planners predict interest rate trends, make investment choices, and manage interest rate risk. Next, we are discussing about bond duration. What is duration? In everyday language, duration just means length of time. But in finance, duration means something deeper. It's about how long it takes to recover your investment and how sensitive your investment is to changes in interest rates. So, think of duration as a hybrid concept. It combines time when you get your money back, risk how your investment reacts when interest rates change. In the context of fixed income securities like bonds, duration helps answer two questions. How quickly do I get my money back, considering the time value of money? How much will the bond's price move if interest rates change? Why is duration important for bonds? Now let's bring this concept into the world of bonds. When you buy a bond, you're essentially lending money to a government or corporation. In return, you receive periodic interest payments and then your principal back at maturity. But unlike a regular loan, those future payments have different values today because of interest rates. So duration helps measure the average time-weighted value of those payments based on present value. It also acts as a risk metric. The higher the duration, the more sensitive the bond is to interest rate changes. For example, if interest rates rise by 1%, a bond with a duration of 5 will lose approximately 5% of its value. Now, let's talk about two types of duration. There are two major types of bond duration you need to know. Macaulay duration. This tells you the weighted average time in years to receive all cash flows from a bond. Modified duration. This tells you how much a bond's price will change if the interest rate changes by 1%. Macaulay duration is the true time-based measure. It shows the average point in time when you receive the money you invested, adjusted for the time value of money. It's calculated as the sum of each cash flow's present value, multiplied by time, divided by the bond's total price. It's like asking, if I spread out all the cash I get from this bond, what's the average time it takes to get my money back in today's dollars? Now, modified duration builds on Macaulay duration, but adds a risk dimension. It measures the percentage change in a bond's price for a 1% change in yield or interest rate. Formula: modified duration equals to Macaulay, duration divided by 1 plus yield to maturity. If a bond has a modified duration of 4 and interest rates go up by 1%, the bond price is expected to fall by 4%. Why does price go down? Because when market interest rates rise, existing bonds with lower coupon rates become less attractive, so their market value drops. Our final topic is benefit and limitation of bond issue. Here are 3 key benefits of issuing bonds. 1. No loss of control or ownership. When a company issues bonds, it raises capital without giving up ownership. That's very different from issuing new shares. With equity, you're giving away a piece of the company, and with that comes voting rights, shared profits, and potential influence over decisions. But with bonds, the investors are just lenders, not owners. They're entitled to interest payments and repayment of the principal, but they don't get a say in how the company is run. This is a major reason why founders and executives prefer bonds. They can fund expansion, acquisitions, or new projects without diluting control. 2. Interest on bonds is tax deductible. Another big benefit? Tax savings? The interest a company pays on its bonds is tax deductible. This means it reduces the company's taxable income, effectively lowering the cost of borrowing. Let's say a company pays $1 million in bond interest. If the tax rate is 30%, the company saves $300,000 in taxes. So the real cost of debt is reduced thanks to the tax shield. This tax advantage makes debt financing cheaper than equity in many cases. 3. Some bonds are callable. Many companies issue callable bonds, which give them flexibility in managing long-term interest costs. A callable bond allows the issuer to repay the bond before maturity, usually after a certain period. This is useful when interest rates fall. Why? Because the company can refinance the debt at a lower interest rate, just like how homeowners refinance mortgages when rates drop. Callable bonds help companies save on interest costs and manage liabilities more strategically. Of course, to compensate investors for this risk, callable bonds usually offer slightly higher yields. While bonds offer many advantages to companies, they also come with important limitations and risks. These factors must be carefully considered before choosing debt financing. Here are 4 major disadvantages of issuing bonds. 1. Debt is less flexible than equity. Unlike equity, debt comes with fixed obligations. Interest payments must be made on time, regardless of the company's profits. With equity, companies can delay dividends if earnings are low. But with bonds, missing a payment can lead to default, lawsuits, or even bankruptcy. This lack of flexibility can put pressure on cash flow, especially during economic downturns. 2. Increases financial risk, default possibility. Taking on debt increases a company's financial leverage, which means higher risk. If the company fails to generate enough income to meet its interest and principal payments, it could default on its bonds. Default damages credit ratings, raises future borrowing costs, and may trigger legal action or asset liquidation. So while debt can boost returns when business is good, it also amplifies losses during hard times. 3. Large future cash outflow, long-term obligation. Bonds are often long-term instruments with maturities ranging from 5 to 30 years. This means the company is committing to a large future cash outflow, not just interest payments, but also the repayment of the entire principal at maturity. This obligation can become a heavy burden in the future, especially if financial conditions change or the company's revenue declines. 4. Restrictive covenants in bond terms. Bond agreements often include restrictive covenants, legal conditions that limit what a company can or can't do. For example, covenants may restrict taking on more debt, paying dividends, selling major assets, making certain investments. These rules are designed to protect bondholders, but they can also limit managerial freedom and reduce financial flexibility. Violating covenants can lead to penalties or even forced repayment of the bonds. Summary: limitations of bond financing. Less flexible than equity, fixed payments must be made. Increases risk of default and financial distress. Creates large future liabilities. Includes restrictive covenants that can limit strategic options. While bonds can be a powerful financing tool, companies must carefully assess their ability to meet long-term obligations and manage the risks that come with debt. Before we wind up this episode, let's quickly review everything we've covered so far. We began by understanding what a bond is and how it works as a debt instrument. Then, we learned how to calculate the bond selling price using present value formulas. We explored the different types of bonds, including convertible, debentures, mortgage bonds, zero coupon, and more. We discussed yield to maturity, YTM, a critical concept in bond valuation. Then we moved on to cost of bond, or cost of debt, including after-tax adjustments and formulas with issuance cost. We covered the structure and legal details of a bond indenture. We learned about Macaulay duration and modified duration, and how they measure time and interest rate sensitivity. We examined the yield curve, how interest rates change with bond maturity. We explored the 4 major yield curve theories: pure expectations, liquidity premium, segmented market, and preferred habitat. Finally, we discussed the benefits and limitations of issuing bonds from the company's perspective. That's a lot of ground we've covered, so be sure to practice questions from your CMA exam support pack. Rewatch this video if you need to review any of the topics. And don't forget to subscribe, like, and hit the bell icon so you never miss an episode. Thanks for watching, and I'll see you in the next episode of CMA USA Exam Coach. Until then, keep learning, keep practicing, and good luck on your journey to becoming a certified management accountant.